Disclaimer.
Silver just smashed $83, but don't celebrate yet. This is not a rally. It's a distress signal for a $300 trillion shadow banking collapse that officially started today. The banks bet on $40. They are now trapped at 82, and the exit doors are locking. You have exactly 72 hours before the physical market completely detaches from the paper lies. Today, I'm exposing the leaked data the bullion banks are desperate to hide. Watch this until the very end, because the math I'm about to show you proves $83 is just the warning shot. Let's dive in. To understand why this moment is so critical, we need to rewind exactly 11 days to January 30th, 2026. That Friday morning, silver investors woke up to financial carnage. The metal plummeted 31.4% in a single session, settling at $78.53 per ounce. Just 30 hours earlier, silver had been trading above $121, a price that would have seemed like fantasy just 12 months before. Then came the crash. In less than 2 days, silver experienced its worst decline since the Hunt brothers tried to corner the market in March 1980. But here's what should really grab our attention. While financial media scrambled to explain the carnage, Treasury Secretary Scott Bessent stepped forward with a remarkably candid assessment. Speaking on Fox News Sunday Morning Futures just days ago, Bessent pointed directly at what triggered the collapse. The gold move things have gotten a little unruly in China, he said. They're having to tighten margin requirements, so gold looks to me kind of like a classical speculative blow-off. No conspiracy theories, no mysterious manipulation. The Treasury Secretary of the United States just told us straight. This was a speculative bubble that popped when leveraged traders got caught on the wrong side of a major policy shift. And silver, being even more volatile than gold, got hit twice as hard. Now, if you've been following precious metals, you might be wondering what actually lit the fuse on this explosion. The answer came from an unexpected place, a personnel decision at the Federal Reserve. President Trump nominated Kevin Warsh as the new Fed chair, and that single announcement sent shockwaves through global currency markets. Warsh served as a Fed governor back in 2006, and he's widely known as a monetary hawk, someone who favors a strong dollar and tight monetary policy. The moment his nomination became public, traders who had been betting on dollar devaluation suddenly found themselves staring into the abyss. Think about what was happening in the weeks before this crash. Silver had climbed from around $30 to over $120 in just 12 months, a fourfold increase that defied historical patterns. Investors piled into precious metals as a hedge against what they believed would be inevitable currency destruction. The trade made sense until it didn't. When Warsh's nomination hit the wires on that Friday morning, everything changed. A hawk at the Fed meant the dollar would likely strengthen, not weaken. It meant the debasement trade, betting that our government would keep printing money until the dollar lost its value, was suddenly in jeopardy. And the selling started, not gradually, but all at once. Chinese authorities had already been raising margin requirements in the days leading up to the crash, trying to cool what had become a speculative frenzy. When the Warsh news broke, it triggered a cascade. Leveraged traders faced immediate margin calls. To meet those calls, they had to sell, not because they wanted to, but because their brokers demanded more collateral. That selling pushed prices lower, triggering more margin calls across the system. According to Bloomberg, China's 4 largest gold ETFs saw a record outflow of nearly $1 billion in a single day that week, the biggest daily outflow ever recorded for those funds. The capital that had flooded in during the rally was now flooding out just as fast. But here's where the story takes a turn that most financial commentators are missing entirely. This crash didn't happen in isolation. It exposed something far more significant about the architecture of our modern financial system, a structure that has grown so massive and so interconnected that even veteran traders struggle to comprehend its full scope. According to the Financial Stability Board's annual monitoring report released in December, non-bank financial institutions now hold $256.8 trillion in assets. Let that number sink in for a moment. We're not talking billions. We're talking about $250 billion sitting in hedge funds, private equity firms, money market funds, and other entities that operate outside the traditional banking system. This crossed the $250 trillion threshold for the first time at the end of 2024, and it now accounts for 51% of all global financial assets. More than half of the world's financial wealth is now managed by institutions that face far lighter regulatory oversight than your neighborhood bank. The FSB noted that this sector grew at double the pace of traditional banking, 9.4% versus 4.7%, reflecting what regulators called a buoyant risk appetite. In an era of rising asset prices, what does this mean for you and me? It means the rules that were supposed to protect our financial system after the 2008 crisis, the stress tests, the capital requirements, the regulatory oversight, apply to less than half of where the money actually sits. The other half operates in what regulators politely call lightly supervised territory. When silver crashed, we witnessed what can happen when concentrated positions in these shadow institutions unwind simultaneously. Margin calls triggered more selling, which triggered more margin calls, creating a feedback loop that stripped nearly a third of silver's value in hours rather than weeks. Now, I want to be completely honest with you about something. The run-up in silver prices was genuinely speculative. A 400% gain in 12 months was not supported by immediate industrial demand or investment fundamentals. It was driven by leverage, momentum, and fear of currency collapse. The correction was brutal, but corrections from speculative peaks always are. What makes this situation different, what should concern every American who cares about their financial future, is the fragility it revealed in our broader financial architecture. We've built a system where $256 trillion can move faster than regulators can respond. We've created markets where a single personnel announcement can trigger 30% moves in assets that have been valued for millennia. Pop quiz: when was the last time you heard a detailed explanation of where the shadow banking system puts its money? When did anyone in Washington hold a hearing about the risks building in non-bank financial institutions? The silence on these questions should tell you something. And here's the thing: silver has already started climbing back. By early February, prices had rebounded above $83 per ounce, recovering more than 10% from the lows as dip buyers stepped in. The volatility works both ways. But the rebound isn't just bargain hunting. Something deeper is happening in the physical market that the paper prices aren't telling you. The silver crash of January 2026 wasn't just about precious metals. It was a stress test for an entire financial ecosystem. And the results should make us pay attention, not because silver went down, but because of how quickly and how violently it happened. The system that was supposed to provide liquidity, market makers, arbitrageurs, stabilizing traders, simply stepped aside and let prices fall. And here's the part that connects directly to your wallet. The institutions holding this massive pool of assets aren't just trading silver. They're trading the same treasury bonds that back your money market fund. They're trading the corporate bonds in your retirement account. They're trading the mortgage-backed securities that determine your interest rates. When stress hits one part of this interconnected web, it can propagate in ways that even the smartest financial engineers don't fully anticipate. The silver crash was a warning shot, a preview of what can happen when concentrated positions, high leverage, and rapid information flow combine in a system that has outgrown its regulatory framework. But wait. If this was just a speculative blow-off, if the crash was simply the market correcting an overextended trade, why should we care beyond the losses suffered by silver speculators? Because what's happening right now in the physical silver market tells a completely different story than the paper price. And that divergence is where the real danger and the real opportunity begins to reveal itself. Here's something that will make your head spin. On January 1st, 2026, while COMEX silver futures showed $72 per ounce, physical bullion dealers in Japan and the United Arab Emirates were selling silver at $130 per ounce. When they could find inventory at all, let me repeat that number so it sinks in. An 80% premium for physical silver over the official spot price. This has never happened before in modern precious metals markets. Gold occasionally sees 5 to 10% premiums during supply crunches. Silver sometimes trades at modest premiums in specific regional markets. But an 80% systematic decoupling between paper and physical prices across entire trading regions? We've entered uncharted territory. And the first CME Group delivery report of 2026 confirms what the premium is screaming. JPMorgan is aggressively standing for maximum physical delivery. According to January 7th data from the COMEX, JPMorgan issued 99% of 8.1 million ounces in delivery notices through over 1,600 contracts. They're not rolling positions forward like normal futures traders. They're taking actual metal out of the vaults. What made this even more unusual? Despite these massive deliveries, open interest in January contracts actually increased by over 1,400 contracts the same day. Traders are rolling backwards from March into January and February to secure immediate delivery rather than waiting. This is the opposite of normal market behavior. In a healthy futures market, participants roll forward to avoid the hassle of physical delivery. When they start scrambling backward, demanding metal right now, something fundamental has shifted. During the first week of January alone, COMEX warehouses experienced a 33.45 million ounce withdrawal, representing 26% of registered inventory vanishing in just 7 days. As of early February, registered silver, the metal actually available for delivery against futures contracts, has fallen to approximately 103 million ounces, down from 167 million ounces in October 2025. That's a 38% collapse in deliverable inventory in barely 3 months. Now, here's the math that should keep every financial analyst awake at night. March 2026 open interest represents approximately 429 to 528 million ounces of notional silver demand. The registered inventory available to meet those requests currently stands around 103 million ounces. If even 25% of contract holders stand for delivery, a conservative assumption during periods of stress, COMEX would need 107 million ounces. That's potentially more than will be available by first notice day on February 27th. The February delivery rate has already reached 98%. Out of 19.11 million ounces of open interest, 18.72 million ounces have been called for delivery. This is not a functioning futures market where contracts typically roll forward. This is a physical allocation mechanism operating under extreme stress. But wait, what triggered this sudden hunger for physical metal? To understand that, we need to look at what happened on January 1st, 2026, on the other side of the Pacific. China implemented the most aggressive precious metals export controls since their rare earth restrictions. Beijing reclassified silver from an ordinary commodity to a strategic resource subject to government licensing. Only 44 companies received authorization to export silver over 2026 and 2027, and they must meet stringent requirements. Annual production exceeding 80 tons and consistent export records from 2022 through 2024. Smaller players are effectively locked out of the export market entirely. This isn't a minor policy adjustment. China controls up to 60 to 70% of global refined silver supply. The South China Morning Post reported that while Beijing officially framed the measure as protecting resources and the environment, market watchers see it as a signal that supply to overseas markets will be further limited. Elon Musk responded on social media with two words that capture the industrial sector: panic. This is not good. He's right to worry. Silver is irreplaceable in solar panel manufacturing, semiconductor production, electric vehicle components, and 5G infrastructure. These aren't optional industries that can simply reduce consumption when prices rise. They're sectors receiving massive government investment across virtually every major economy. When China tightens its grip on silver exports, the entire global technology supply chain feels the squeeze. Treasury Secretary Bessent understood the urgency. On January 12th, he convened an emergency meeting of finance ministers at the U.S. Treasury, gathering officials from 11 countries, plus the European Union Commissioner, to address what he called key vulnerabilities in critical mineral supply chains. The attendees read like a who's who of global economic power: Australia, Canada, France, Germany, India, Italy, Japan, Mexico, South Korea, the United Kingdom, and the European Union. According to the official Treasury statement, Bessent opened the meeting with a blunt assessment. Supply chains are too concentrated. They're weak. They're easy to disrupt. We need to fix that now. Representatives from the U.S. Export-Import Bank and JPMorgan joined government officials to explore collaborative ventures, a remarkable admission that the private sector and public sector both recognize the crisis. German Finance Minister Lars Klingbeil warned that Europe cannot afford to sit on its hands. Neither complaining nor self-pity helps us, he said. We have to become active. He pointed to a new German raw materials fund as a possible model and called for faster action at the EU level. The meeting focused on diversifying supply chains for critical minerals, including rare earths, cobalt, lithium, graphite, and silver. According to the International Energy Agency, China dominates the critical mineral supply chain, refining between 47 and 87% of copper, lithium, cobalt, graphite, and rare earths. For silver specifically, that concentration is even more acute. Just 3 weeks later, on February 4th, Secretary of State Marco Rubio hosted an even larger gathering, the 2026 Critical Minerals Ministerial, bringing together representatives from 54 countries and the European Commission, including 43 foreign ministers. The State Department announced billions in financing for alternative supply chains, including new bilateral frameworks and memorandums of understanding across the globe. The scramble is real, and it tells you everything about how seriously Washington is taking the supply disruption. But here's what the mainstream financial press still isn't explaining clearly. The January crash didn't fix the fundamental problem. It interrupted it briefly, then the underlying forces resumed. Despite silver falling from $121 to $78 in 30 hours, the physical market divergence actually widened in certain regions. Shanghai physical premiums exceeded $8 per ounce above COMEX prices throughout late December and into January. Indian buyers offered $5 premiums to secure metal. PAMP Swiss bars in the UAE listed at prices reflecting massive markups over spot. Why didn't the crash bring buyers flooding back into paper markets? Because sophisticated participants understand what the delivery data is telling them. The paper market represents claims. The physical market represents actual metal. When those two things diverge by 80%, smart money starts questioning whether the claims can be honored. Sprott, Physical Silver Trust announced on January 20th that it had doubled its at-the-market equity program to issue up to $2 billion of new units, proceeds earmarked entirely for physical silver acquisition. At current prices, that represents approximately 18 million ounces of buying power, equivalent to roughly 16% of current COMEX registered inventory. Institutional investors are voting with their dollars, and they're voting for allocated physical metal over paper exposure. The supply picture makes this urgency understandable. For 5 consecutive years, global silver demand has exceeded total supply. In 2025, demand reached an estimated 1.24 billion ounces, while total supply, including mine production and recycling, amounted to only about 1.01 billion ounces. That's a structural deficit of over 200 million ounces annually, and it's been accumulating for half a decade. Major miners aren't helping. Fresnillo, the world's largest primary silver producer, cut its 2026 guidance to 42 to 46.5 million ounces, down from 45 to 51 million, citing operational phasing and a shift to narrower, lower-grade veins. The easy silver has already been extracted. What remains is harder to reach, more expensive to process, and slower to bring to market. Now let's talk about what experts actually say about where prices might go. Brett Elliott, Director of Marketing at American Precious Metals Exchange, told CBS News that reaching $200 per ounce would require something intense. His exact words? It would have to be something like a major exchange defaulting on their contractual obligation to deliver silver. Think about that statement carefully. A market professional is publicly discussing the possibility of exchange default as a potential catalyst. That's not conspiracy theorizing. That's professional risk assessment from someone who moves physical metal every day. Vince Stanzione, founder and CEO at First Information, offered his own timeline. I do see $200 silver and $7,000 gold, likely before the next U.S. elections in November 2028, but that would probably mean currencies are all devaluing significantly. He's describing a scenario where precious metals prices aren't really rising. The measuring stick we call the dollar is shrinking. The tension between paper and physical markets has reached a breaking point that even mainstream analysts can no longer ignore. When Treasury Secretaries convene emergency ministerials, when major trusts double their buying programs, when delivery rates hit 98%, and when registered inventories collapse by a third in 3 months, these aren't speculative fantasies. These are observable facts from official exchange data. The question isn't whether the silver market is under stress. The question is what happens when that stress reaches the point where someone demands metal that does not exist in the vault. And with March delivery approaching and only 21 days remaining until 429 million ounces of theoretical demand meets 103 million ounces of available supply, that question may be answered sooner than anyone expects. As I record this on February 10th, 2026, silver is trading around $83 per ounce, climbing over 5% just today. Gold has reclaimed the $5,000 threshold after its own historic volatility. The recovery from the January crash has been swift, but the question everyone wants answered is simple. Where do we go from here? Let me give you both sides of this debate, because honest analysis requires acknowledging that brilliant people disagree violently about what happens next. On the bearish side, former JPMorgan chief strategist Marko Kolanovic isn't mincing words. He's calling for silver to crash back to roughly $50 per ounce, a 50% decline from current levels. His exact phrase was that this outcome is almost guaranteed within a year or so. Kolanovic sees what he describes as meme traders attempting to take over the market, and a speculative mania destined to unwind violently. His logic is straightforward. Silver behaves less like a store of value and more like a leveraged macro instrument. When positioning unwinds, it unwinds hard. A 50% crash would not be unprecedented. It would be historically normal for a commodity that has rallied this aggressively. MKS PAMP analyst Nikki Shields pointed to unheard of volatility, and prices driven less by physical supply and demand than by wild liquidity flows. Bloomberg Intelligence's Mike McGlone takes a similar view, suggesting silver could retreat toward $50, making 2026 a down year. Julius Baer's Karsten Menke warns that the market hasn't found equilibrium yet, and violent swings will persist until speculative excess is completely flushed out. But here's where it gets interesting. The same Marko Kolanovic who predicted the crash has already started hedging his bearish stance. After the January 30th collapse, he posted on social media, "As much as I wrote against silver past few days, today it just might bounce." Legendary commodities trader Peter Brandt, a 50-year veteran who began his career in 1976, sent a similar message, predicting a near-term rally before potentially more downside. Brandt added something crucial, however. 2226 is not 2011, he wrote. In my mind, the 2011 rally was destined to return back to the teens. Not this time. I do believe there is more ahead for silver, but not until the hotshot know-it-all bulls are thoroughly washed out. Then price can go back up. maybe not until later in 2026 or even early 2027. That's the bearish case with an important caveat. Even the bears don't think we're going back to $30 silver. The structural picture has changed too fundamentally. Now let's examine the bullish scenario. JPMorgan, the same bank where Kalanovich built his reputation, just raised its gold price target to $6,300 per ounce by year-end 2026, the highest forecast among major global institutions. They're projecting central banks will purchase around 800 tons of gold this year alone, creating what they call a structural continued diversification trend away from paper assets toward real assets. If gold reaches 6,300 and the gold to silver ratio returns to its historical average around 55 to 1, that implies silver prices between $115 and $120 per ounce. If the ratio compresses further toward the 40 to 50 range, which happened during the January peak, you're looking at $130 to $160 silver. Vince Stanzioni, founder and CEO at First Information, has put a specific timeline on his forecast. I do see $200 silver and $7,000 gold likely before the next U.S. elections in November 2028. He added the critical caveat that such prices would probably mean currencies are all devaluing significantly. Robert Kiyosaki, the financial author behind Rich Dad, Poor Dad, posted $200 next after silver broke $80 in late December. He has previously predicted silver could reach $500 from $100 within a year, calling it hotter than gold. Bank of America sees silver averaging between $85 and $100 per ounce in 2026, calling it the primary strategic metal of the green transition. UBS targets $95, while Citi points to a potential move toward $110 in the second half of the year. JPMorgan's own commodities team expects silver to end the year near $125 per ounce, supported by multi-year supply deficits and resilient industrial demand. Alan Hibbert of Gold Silver offered perhaps the most striking prediction. I'm expecting silver to perform better in 2026 than it did in 2025, when it gained 147%. I wouldn't be surprised to see the price of silver increase by over $100 per ounce to $175 or higher. So who's right? The bears calling for $50 or the bulls calling for $200? Here's my honest assessment based on the data we've examined together. The bearish case requires ignoring several structural realities. China's export restrictions are not going away. They're a 2-year policy through 2027. The physical supply deficit is not theoretical. It's been documented by the Silver Institute for 5 consecutive years, with demand exceeding supply by roughly 200 million ounces annually. COMEX registered inventories aren't stabilizing. They're still draining at nearly 800,000 ounces per day. The bullish case, on the other hand, requires the paper market to eventually reconcile with physical reality. That's a big assumption because exchanges have historically proven creative at avoiding delivery failures. They can raise margins, force cash settlements, invoke force majeure clauses, or simply change the rules mid-game. What I believe is most likely sits somewhere between these extremes, but with an important asymmetry. The downside is probably limited to somewhere in the $60 to $70 range, a level where industrial buyers would aggressively step in to secure physical supply. Multiple analysts have identified this zone as strong technical support coinciding with the 200-day moving average. The upside, however, is genuinely uncertain in a way that favors holders of physical metal. If even one major delivery failure occurs, if one exchange admits it cannot fulfill its contractual obligations, the psychological impact would be devastating for paper markets and explosive for physical premiums. Brett Elliott at American Precious Metals Exchange told CBS News that reaching $200 would require something intense, like a major exchange defaulting on their contractual obligation to deliver silver. He wasn't predicting this outcome, he was describing what it would take. But the very fact that industry professionals are publicly discussing exchange default as a price catalyst tells you how unusual this moment is. Now let me bring this back to what it means for you, because understanding market dynamics is useless if you can't translate it into actionable awareness. The $300 trillion shadow banking system we discussed at the beginning isn't going away. The $256 trillion in non-bank financial assets will continue growing faster than regulators can supervise. The interconnections between commodity markets, currency markets, and your retirement account will only deepen. Silver's January crash wasn't an isolated event. It was a preview of what happens when concentrated positions and leveraged instruments unwind simultaneously. The same mechanics that stripped 30% from silver's value in 30 hours exist throughout our financial system, in treasury markets and corporate bonds and mortgage securities. What makes precious metals different is their physical nature. When you hold actual silver, coins, bars, allocated bullion, You own something that exists outside the chain of counterparty claims. You're not dependent on a bank honoring its obligations, an exchange fulfilling its contracts, or a counterparty remaining solvent. The 72 hours referenced in our title isn't arbitrary. March 1st, notice day arrives on February 27th, 17 days from now, when 429 million ounces of open interest meets 103 million ounces of registered inventory. Something has to give. Either most contract holders will roll forward as usual, or we'll witness the most significant delivery stress in COMEX history. Treasury Secretary Bessent called the January move a classical speculative blow-off. He's probably right about the paper market dynamics. What he didn't address, what no government official has publicly addressed, is the growing divergence between paper claims and physical reality. $83 today, perhaps $50 if Kalanovich is right about speculative unwinding, perhaps $200 if the physical market truly detaches from paper pricing. The honest answer is that nobody knows with certainty. What we do know is this: the largest financial institutions in the world are repositioning. JPMorgan is taking maximum physical delivery. Sprott has doubled its buying program to $2 billion. Central banks added 800 tons of gold in 2025 and show no signs of slowing. The Treasury Secretary convened emergency meetings with 11 finance ministers to address supply chain vulnerabilities. These aren't the actions of institutions that believe everything is fine. These are the actions of institutions preparing for a world where paper promises face increasing scrutiny. Remember where we started, with silver crashing 31% in a single session while most Americans slept. That crash revealed the fragility built into a $256 trillion shadow banking system that has outgrown its regulatory framework. Well, the question isn't whether silver goes to $50 or $200. The question is whether you understand what that volatility is telling us about the broader financial architecture. Silver is not just a metal, it's a barometer measuring stress in a system that most people don't even know exists. $83 is just the warning shot. What comes next depends on whether the paper market can continue pretending that claims and reality are the same thing. 17 days until March delivery begins? The math doesn't lie, and neither does physical silver sitting in your hand instead of someone else's vault. Stay informed, stay aware. And remember, in a world of paper promises, the only asset without counterparty risk is the one you actually hold.